So I've been discussing on my radio shows recently how when volatility breaks out, things get very different. And when I say volatility breaking out, I mean amongst the levels that I've talked about in the past, VIX north of 26, VIXN, which is for the NASDAQ volatility north of about 30, 31, and Russell 2000 volatility, RVX, above 27. And they've done that. And so over the past three trading days, we've obviously had some pretty serious down movement in equity markets in general, U.S. equities. But we've seen it in some cross asset as well, cross assets such as commodities, in some bonds, things of that nature. So there's an interesting subset of things taking place, and much of it's related to the U.S. dollar. So if we look at U.S. equities, you've got the NASDAQ down about 4.1% today. The last three trading days, it's down just shy of 10%. And that's on the heels of its volatility measurement breaking out at the end of last month, which I've talked about in previous videos and emails. And the S&P didn't fare much better. I mean, it was down 2.8% today, which takes its three-day running total down to about off almost 7%, again, in just the last three trading days. So, those are pretty significant numbers for most portfolios. And in most cases, most people are pretty heavily loaded into U.S. equities. We are not. By comparison, the average moderate type portfolio here was off about a grand total in the last 3 days of roughly 1.5%. I mean, I don't like that. I don't like to lose. So, I'm with you. But the volatility measurements and the spikes that have occurred and the follow-on price movements have happened really pretty fast. When Apple and Tesla split their shares 5-for-1 last week, they were hitting all-time highs, and their volatility measurements were really escalating. And I commented in a few emails and a few conversations with people that those are the kinds of things that make me a little bit nervous. Back in 1999, there was a company by the name of Qualcomm. Still trades today under the symbol QCOM. And in 1999, they did a 4-for-1 split, and the stock basically went straight down. I mean, like 80% down. Back then, the NASDAQ followed suit, but it took 1 to 2 months for it to really happen. Why am I using that comparison? Because back then it was a tech bubble. Right now it's a tech bubble. It's very similar. And so having tech exposure, specifically U.S. equity, U.S. tech exposure, I'm not saying it's going to crash to the extent that we saw in 1999, but if volatility measurements keep escalating with price moving down and volume moving up, those are three things that when volatility's up, volume's up, and price is down, that's bad. That's not what you want. You want the exact opposite of that. If price is down, you want volatility and volume down with it, at the very least. So the when you start thinking about where the movements are taking place in the context of the economic structure, we have to remember in the United States, we're still right now, as far as the economic sine curve is concerned, in quad 3, which is stagflation. That's slowing growth, accelerating inflation. Compare that to places like China, which is in quad 1, which is accelerating growth and decelerating inflation. It's a Goldilocks kind of an environment. And quad 2, which is growth with some accelerating inflation, which is still good in terms of overall equity exposure. And where those places exist, again, are China, Indonesia, Russia, Norway, and Finland. Russia, Norway, and Finland didn't do great today only because they've got a lot of oil exposure. And oil was down heavily today simply because of the movement of the dollar. There are a lot of interconnected parts in markets these days, and there are a lot of oddities that are happening in markets too, which is why everything we do is completely rules-based. It's all a function of what goes on with price, volume, and volatility, and we simply follow what the math says. And so what we've been doing is about a week ago when the U.S. dollar hit a low, you noticed that I raised a bunch of cash as that was taking place because it looked like the dollar was short-term trade oversold. And when you get an oversold signal, you typically end up with some kind of a bounce in that thing. And we've had a bounce in that thing, namely the US dollar. And so when the dollar started bouncing, it started hitting the top end of the mathematical range a few days ago. And so as that happened, I started to reload some of the commodity exposure that I had taken down, specifically oil, because oil was the first one to hit the low end of the mathematical range as the dollar was hitting the top end of its mathematical range, while its volatility component was very tame, like below 40, right, in the three handle kind of a scenario. And for oil, that's really, really good. So, as is typically normal for how I enter into a position, I started adding 0.25% of capital per transaction in things like oil, Russia, Norway, Finland, natural gas, dollar-sensitive assets, right, commodities in general. And so as that's taken place, unfortunately, sometimes as it occurs, you get a little bit stronger of a move in a thing because of a volatility spike than what you would like or anticipate. That being said, I think the US dollar is getting very close to a point of being overbought. And when you get a thing that's overbought, tapping the top end of its mathematical range while its volatility measurement is staying contained, it's likely that that thing reverses. And so that's what would be anticipated or expected for the US dollar, is for it to turn around and start to go back down. Remember, we're still heavily in the motions of a lot of monetary printing, a lot of experimentation with modern monetary theory, MMT. If you want to learn more about that, Stephanie Kelton has a book about it. It's not to suggest that I agree with her thesis, but she's very bright, and she certainly explains what modern monetary theory is, so that you can have a little bit better handle on how it's functioning and how it's working, because we're in the middle of it. We in the United States of America are experiencing modern monetary theory to its fullest extent, and it's, I think, going to continue for some time, which means a lot of money printing. And when you have a lot of printing in that thing, it's likely that that thing is going to decrease in value. So we're still bearish the US dollar. And we're bearish the U.S. dollar because we are in that stagflationary type of an economic structure, and will be at least, I think, through this quarter. And so that's the hand that we're playing. Now, if that changes, if we somehow roll back into deflation, which I don't anticipate, but anything's possible. But if we roll back into deflation, then that would spell some very bad economic structure across the curve, right? For basically everything, commodities, stocks, bonds, you name it. I don't anticipate that to happen. The Fed knows that they cannot lose control of the bond market. By losing control of the bond market, what I mean is allowing its volatility measurement to really, really spike. Now today, the MOVE index, which is the volatility measurement for U.S. Treasury bonds, peaked up above over 50. Now 50 is kind of one of those levels where it's difficult to make a choice and a decision on what to do. However, going into the close today, we were north of 8% on long-term treasuries and 5% on extended duration bonds. And I decided to take those down some for a few reasons. One, the MOVE index spiked up above 50. I don't expect it to stay there, but nevertheless, when that volatility is accelerating, you get a little bit more cautious with that asset class in terms of being outsized. And I had a fairly decent position in that bond holding. The other reason why is that the mathematical probability of the top end of an interest rate on the 10-year Treasury went from 0.71% to 0.74%. And so that just means that interest rates could travel to the upside a little bit more before reversing. And we've seen it happen a number of times now over the past several months, where interest rates would spike to a level, it would hit our trend resistance level, and then literally turn around on a dime and start falling again. We saw it last week. And so when that happened, it spiked up. We bought some bonds at a fairly low price, and now interest rates today were down a reasonable amount. But I decided to take some of those profits. I decided to book some of that because the MOVE index moved up and because the top end of the interest rate cycle moved up a little bit as well, which again can come down just as fast as it went up. So again, the things that are in a quad one, quad two in terms of an economic structure, which are good, they're bullish in general for overall equities of those places, are places like China, Indonesia, Russia, Norway, Finland. And on top of that, their volatility measurements have stayed much, much more tame than what the VIX for the S&P 500 or the VIXN for the NASDAQ have stayed. Those have broken out into a bullish trend, which is bearish for those equities. If we get a dollar top that then moves to the downside, I would expect all asset classes to move up because there are inverse correlations with stocks, oil, commodities, and gold. And it just wouldn't surprise me to see that happen here over the next day or so as the dollar gets extremely overbought and reverses. What are the kinds of things that could really, really change that from happening? It's hard to say, considering where we are within this current economic structure of stagflation, with the money printing that's going on, with the continued movement of stimulus and things of that nature, and of course moving into an election within the next couple of months. It just doesn't seem highly probable that the Fed would allow the bond market to get out of control, which then would eke over into the equity market and allow it to get out of control. Chances are better than good that places like China, Indonesia, Russia, Norway, Finland, you buy the dip because the volatility measurements are not out of control. You stay away from, unless you're willing to trade very, very heavily, things in the S&P and the NASDAQ until those volatility measurements come down. And we carefully pay attention to the commodity zone in terms of what the dollar is doing. If the dollar hits a overbought level that I think it's pretty close to being at and starts coming down again, all those commodities will start to move up. Oil will probably be the quickest and fastest mover. And so we've got some pretty good exposure to oil and oil-related assets that, again, are very dollar sensitive. If something should change where the dollar scenario, for whatever reason, changes its structure because somehow the economic sine curve breaks, which would be very odd. Is not something that is very typical, and I would have to go back a very, very, very long way to see anything that would even resemble that. Just know that I would take down exposure very, very quickly to continue to protect any kind of a downside movement in asset classes. So again, the U.S. equity markets are off considerable amount at this point. We are not. We haven't had U.S. equity exposure. I've got a little bit of exposure in utilities and a little bit in real estate. Outside of that, all of our exposure has been focused on bonds, commodities, gold. We view gold as a currency, and again, some of these markets that are international that have a volatility measurement that have been very calm. So until that changes, I'm going to continue to do those things that have historically worked within the lens of the current economic structure that we're in. I'm going to continue to focus on that thing that is causing the current markets to pull back some, and that's the U.S. dollar. If the inverse correlations really work themselves out of the U.S. dollar, then certainly we can adjust that and change those positions as needed. But until that happens, nothing's changed. There's no emotion in this. It's just simply following the rules. It's looking at the math every single day. It's adjusting based on what the math is telling us on the movement of price, volume, volatility. Those are the three major things, volatility being the most important. So as volatility expands, and it does and has in most all asset classes right now, then we expect price volatility to follow. And as volatility starts to squeeze or get condensed or come in, then money will start to move into those asset classes again. I think oil probably hit a top in terms of its volatility measurement. Trend was right at where it stopped today. And since trend was right at where it happened to stop, that's why we would anticipate or expect for the movement of that asset class, specifically, the price of oil. We would expect the price of oil to probably bottom out here pretty soon. That's the expectation. So, at any rate, as always, if you have any questions at all, give me a call. I didn't really share any charts with you today, but that's okay. I just wanted to give you a quick synopsis in terms of where we're at as a whole, in terms of a portfolio update, in terms of the kinds of movement that we've experienced here in the very near term, and just as importantly, what we're doing about it to try and capture the opportunity that exists once that dollar ultimately flips into its continued bearish mode, which we think is here. So if you have any questions at all, please let me know. Direct line 608-354-1977. Email chris@careformywealth.com. And as always, no such thing as a silly question. Always thankful to hear from you. And as always, thank you for letting me work for you. Appreciate it. Have a wonderful night.